So, an important aspect of a desirable economic system is that the market for corporate governance works. The market for corporate governance is essentially encouraging the managers to perform well to create value for shareholders. And what happens in the real world often is that entrenched management, due to information issues, do not really have to deliver performance. And that is a loss for not only the shareholders of the firm, but the society at large. So, this is like rather common. Entrenched management of large firms have no accountability unless the founders continue as CEOs or have a significant influence in the choice of the CEO, or there is a rare CEO who is a high performer. And these poorly run firms where the senior management is insulated from market pressures, does not have accountability, are not good places to work. They're rife with politics, and they spend a lot of time on posturing, right? Like virtue signaling. Okay, now, of course, I've already discussed how larger firms should be split into smaller firms, because smaller firms are better, have better accountability, have a better culture. Now, there's other solution, and that is if it is to make the market for corporate governance work better. Okay, so I spent some time on this issue, and I realized that the problem with corporate governance not working right is fragmented shareholders. It is not worth the reward for small shareholders to invest resources of time and money holding the entrenched management accountable. So that is like the source of the problem. And now there is supposedly this market for corporate governance where corporate raiders are supposed to take over firms which are not being run well, turn them around, and get a share of the increase in value. Now, however, there is an issue, you can say free rider issue of this in this market, and it is essentially that the shareholders would expect that the value of the firm would rise after the takeover, and this would cause the price to rise before the takeover itself. The shareholders would not sell their shares at the lower value, at the value at which the current management is producing for the firm, because they realize that this rate is going to come in and increase the value. So they would only want to sell at increased value. Now, however, if they are not ready to sell at the lower value, then the raider would have to pay more, and this would reduce the value of the gain the raider would make. Okay. And really, I mean, the existing shareholders will want to only sell at the new value which they expect the firm to be, or if it's if they think that there's a certain probability of a high value and a certain probability of the continuing low value, then And if they're risk neutral, then they would take the they would put the value of the firm at the expected value, and they would be, if they're risk neutral, they would be willing to sell at the expected value. Anyway, which would still reduce the gain which the trader would make. It becomes sort of a game theoretic situation. If the shareholders raise the price to the value which the shareholder would achieve, then the shareholder does not have any incentive to take over the firm anymore. And in which case the shareholders will not receive that gain in value. So now I found that this problem of corporate governance had actually been discussed. A couple of academics had already discussed this problem. That happened with most of my ideas when I was a PhD student. Somebody else had already done it, and I was not great at reading existing literature, so I used to come up with these ideas which were already there. Anyway, what was not there was a solution. Identifying the problem is important. Offering a solution is even more important. Okay, so what can be done to make this market function? Now, you can put a set of covenants into the firm's charter which will facilitate the takeover of the firm by the raider. Now, why would a firm want to put such a covenant in its charter? Well, part of the covenant is that there will be a premium on the existing share price. Now, if the raider is ready to pay a premium of, let's say, 10%, could be 20%, could be 100%, I don't know, and say that they want to purchase 35%, and the covenant says that they have to purchase at least 35% of the firm, let's say, to give them control, or whatever the shareholders think, or whatever the raider thinks will give them control. So this could be like, for example, it could be like 25%. Okay, and this could be like the premium could be over the average of the last 25 trading days, which is essentially to, if the news leaks out, then the raider still doesn't have to pay the higher price. Or if you want to give the raider more comfort of the news leaking, not leaking out, then you can make this like 40 days, let's say, of the past 40 trading days. That'll be about 2 months. And then the firm will either issue new shares or buy existing shares. And they can give them they'll give them the premium of that 10% or whatever premium, and to get the raider to the required 25%. Or if the raider believes that they want a larger share, then they can say like 25 to 70%. Now, of course, the problem with a higher percentage is that the raider has to come up with more funds. Now, the raider may just want some inside information, and the firm is just not going to go around handing out inside information to anyone and everyone who wants it. So what they can do is that they say, okay, you pay me like 0.1% of the market capitalization, and then you can have a detailed knowledge of the firm, things which are not even required to be publicly disclosed. And let's say if the raider does not follow through after receiving this information within like, I don't know, 12 weeks, 3 months, to then the 0.01% is forfeited. If you introduce these covenants, it doesn't even require a raider to come in for an increase in the market value of the firm to happen. You're the shareholder of a firm. You should agitate for a firm to put this in their covenants right away, because as soon as you put those covenants in, you should see the price of the firm increase. And that is so because the probability that there will be a rate in the future goes up. And if you want, if you think that, okay, 10% premium is too less, make it 20%. But put that covenant in. If you're an activist shareholder, put these covenants in your firms. Not only will it increase the probability that there will be a raider who will increase the value of the firm in the future, but also existing management will become better performing because they will understand that they are no longer entrenched and they will have to deliver superior performance if they want to keep their jobs. Activist shareholders, note, these are the covenants. Make it happen. Okay, so let's look at an example. One firm I mentioned was this big tech firm, which at one point was a dominant big tech firm, okay, in the market. Not many decades ago was a dominant big tech firm. But after, starting around the 2010s, its market cap has remained stuck at 120 billion for about 8 years, maybe 10 years. During the same time, competitors who went to the cloud and executed well experienced the 3 competitors, and the average increase in their market cap was $2,000 billion each. And this big tech firm, which did not experience this thing, was actually, I would say, because of its existing relationships with corporations, I would say that it actually had an initial advantage, but it completely blew it. Okay? Now, if a raider had gone in and, the $6,000 billion increase in market cap across these 3 firms, if it was distributed among 4 firms instead of 3, then the market capitalization would have increased by $1,500 billion, which is something which the shareholders of that firm lost because of that entrenched management. If the raider got 35% of the increase in value, that would be about $565 billion. That is very lucrative. For such a large firm, you may even say that, the raider could even get control of it at 15%. 15% of 120 billion is 18 billion. That's not difficult to finance. The famous takeover back in the 1980s was even larger. Okay, and then if the raider had let's say 15% of the value of this increase of 1,500 billion, then this would have been $225 billion increase in value to the raider. And the government could tax this. The raider should still have enough left over to make it worthwhile. It may not be $6,000 increase in total value for this sector, because once you get a 4th firm which is also competitive, then the surplus which these firms receive decreases, but the rest of the world experiences an increase in surplus. So this is beneficial for the society at large. And also, so there are two reasons why it benefits the rest of the society, because firstly, the government gets a share in the increase in value in the form of taxes. And because of more competition, also society benefits. And of course, these farms are going to be better run, which is the nice thing, because you really want to work for a well-run farm. So, raiders don't have the best public image, but so the question is that should we really be increasing the power of the raiders with such covenants? Absolutely. Absolutely, because raiders may have not a great image, but the entrenched management, they do a good job of image management, but they are really, they really need to be reformed. Okay, now, raiders who get wealthy by turning around poorly performing firms are doing a service to society. Give them an opportunity to create wealth and tax them hard. They'll get very wealthy even after paying the taxes, and the government will gain from the taxes it will receive. Also, what about job losses? Because often, efficiency post takeover involves significant job losses to existing employees. But really, if you want to protect, jobs should be protected, but they should be protected by national laws rather than relying on inefficient firms to maintain bloated payrolls. There should be mechanisms at the national level to compensate workers who lose jobs and to provide them attractive alternative employment, rather than saying, yeah, let's keep these bloated farms which are badly run but protected from competition, either due to size or whatever. That's not it's not really a nice place to work. So, it's better to work in a firm that is demanding but rewards performance, and it should be the government which is responsible for providing alternative, attractive employment. Okay.